Lawsuit against Bank of America on Tuesday, accusing the bank of defrauding its investors. The Justice Department, along with the Security and Exchange Commissions, says that the bank vastly understated the risks involved in its sale of residential mortgage-backed securities, ultimately defrauding investors of $850 million. Now, the lawsuit alleges that the banks made misleading statements to these investors and did not disclose important information about the details of the mortgages that comprise these securities. Now, joining me to discuss the matter is Anthony Randazzo, Director of Economic Research at Reason Foundation. How are you, Anthony?
Well, great. Thanks for having me.
Now, first off, can you explain in layman's terms, please, what these mortgage-backed securities are and how they played a role in the financial collapse?
Well, essentially, Bank of America worked with third-party groups who gave out mortgages, and then they bought the mortgages from those third-party groups, put them into packages, and allowed for institutional investors, those are pension funds or big companies that have a lot of money around that they want to invest, to buy those pieces of those mortgages to get every time you pay your mortgage, some of that money would go through to the investor. So that's the mortgage-backed security that was being sold to these investors.
Now, is this the first time the banks or Bank of America has faced prosecution for its role in creating these mortgage-backed securities?
Well, there have been a number of lawsuits, and a lot of the lawsuits and settlements so far have been about what happened after the crisis, particularly in relation to how banks like Bank of America worked with foreclosures. This is one of the first big lawsuits about the creation of mortgage-backed security and not telling investors everything about them, or so the Justice Department and the SEC claims. And so what's big about this particular case is, in addition to its size, is whether or not it can be proved that there was malicious intent on behalf of Bank of America to defraud investors.
Now, B of A, they bought Countrywide, which proved to be a very bad financial decision. Do you think Countrywide knew what it was doing when it created these toxic mortgages?
Well, it's clear that when Countrywide's individual lenders often were handing out mortgages, oftentimes they were doing it knowing that people weren't going to be able to repay. I mean, a lot of mortgages were given without any sort of serious documentation. This particular deal, though, was for mortgages that were the mortgage-backed securities that were sold in January of 2008. So this specific deal, and it's important in this case, is about mortgages that were given out and were sold after the housing bubble was already starting to deflate. Banks had a lot of losses on mortgages in 2007. So by January of 2008, Bank of America was well aware that there was problems in the housing industry. Investors were well aware that there was problems in the housing industry, particularly given the billions of losses that banks had suffered in late 2007. This is not exactly what was going on in the heart of the housing bubble. And so I think what's important to consider is, did Bank of America have a consistent pattern, and Countrywide, a consistent pattern of defrauding the institutional investors that were buying mortgage-backed securities, or was it just in this one particular instance that the SEC and Department of Justice can prove that there was malicious intent and not a non-disclosure of all the necessary important documents?
Now, what do you think this newest lawsuit we're talking about means for Bank of America, and what do you predict will happen?
I'm not exactly sure what's going to happen because there's a lot of the paperwork that still needs to be publicly gone through. I think that one of the problems with this case is that if you look at the SEC's filing, the first thing that they say is they put this in context of the whole financial crisis. And this is a deal that was done in January of 2008 while the housing bubble was already starting to deflate, not the heart of it. And I think that's problematic to try and go after them more broadly. That being said, what it does look like is that there were a number of disclosures that weren't issued properly, like Bank of America, so they might be able to prove that by the letter of the law they definitely violated claims. But investors were investing in this because Fitch gave $822 million of this deal a AAA rating. So investors and Bank of America were depending on a credit rating agency to do a lot of the due diligence on this particular batch of mortgages. That credit rating agency gave it a AAA rating for almost all of it, and everybody was just happy and kind of went along with it. So it may be that they failed to follow the law and it wasn't malicious, which, given that credit rating, I wouldn't be surprised if that's what happened. But because this was 2008, it would be somewhat surprising that they really didn't know what was going on.